That's the closing bell on Wall Street, and now it's market domination overtime. Let's start with where the major averages ended the session here, and the answer is higher, but not at the highs of the day following the press conference from Jay Powell. So the Dow finishing the day higher by about 385 points. That's about 0.9%. The S&P 500 up about 1.1%, but its highs of the day was up closer to 1.5% or so, 1.3%, and the Nasdaq up 1.4%.
The Nasdaq rise stands out to me, Julie, because we were up over 2% at one point here today, and it felt really risk-on, like one of those Fed meetings going back a couple years where, the Fed's dovish, the Fed's going to cut soon, everyone goes and piles into risk-on, and then it's sort of unwound pretty quick, which I think speaks to the market action we've seen as of late, which is kind of, do I dip my toe in? Do I feel comfortable dipping my toe in? And the other thing that stands out, if we can work our way to it, was the bond yield drop, right? So we talked about the 10-year moving a little bit lower today, which was moderately surprising, I think, to some extent, because you had the Fed's SEP and sort of the median projections there. You had 8 officials saying maybe one cut or no cut, but you had bond yields move a little bit lower.
And you have still the market seeming to price in 2 to even maybe 3 cuts this year, which doesn't seem to mesh with what we heard from the Fed.
No, not quite. It seems like Jerome Powell did not want to commit to when the Fed will cut again, really necessarily if they're going to cut again. He sort of balked at a May meeting, said probably not, more or less. And then that pushes the question of when would we get a little bit more certainty, it seems like, and what policy is going to be, how we can factor that in. But I don't think we left this meeting with a crazy amount of confidence necessarily with where the Fed's path is headed. I don't know how much.
And the timing of it for sure. A couple other things to check. Even as yields went down, the dollar still remained higher, at least a basket of currencies versus the dollar. So up about 0.25% there. That was something that Matt Miskin was watching, I know, during the meeting as well.
Yeah, well, and the dollar had plunged during that recent drawdown that we saw in the equity market, right? So I think we have reached a level on the dollar where people are sort of arguing, I don't know how much more downside we need on the dollar, right? We had gotten to the point where the dollar was so strong that it was a headwind to equities, but you kind of wanted to perhaps maybe stay in this range at this point and not move too much lower if you're an equity guy.
And then a quick check on the sectors here. Oh, we're already on the sectors. How convenient. So we've got really rotation out of defensives and into more consumer discretionary, the XLY, energy, industrials, tech. So all of that kind of taking the lead on the
fits the narrative of what Jerome Powell said about the economy, right? For now, they feel things are solid. So perhaps, you move out of those defensive sectors, you go if the economy's slowing.
For today, at least. We'll see what happens tomorrow. Well, stocks indeed rallying on the heels of the Fed decision and Fed Chair Jay Powell's news conference, where the central bank maintained its outlook for 2 rate cuts this year. The tech-heavy Nasdaq outperforming, rising roughly 1.5%. Joining us now, David Sekera, Morningstar Chief U.S. Market Strategist. So, David, interesting to see, as we were just talking about, this kind of cyclically led rally in the wake of the Fed, consumer discretionary, tech helping lead the way here. What do you make of it?
Yeah, well, first of all, I kind of have to joke, but I'm not really joking. I don't think I've ever heard Jerome Powell use the word uncertainty as many times as I've just heard now. And I'm just looking at the market reaction. To some degree, I'm a little bit surprised by just how much the market was moving today. I think at the end of the day, the market's really just comforted that it appears that the Fed's not necessarily overreacting to the potential inflationary consequences of tariffs, as that would just only make the growth hit worse than it otherwise would be. And looking at some of the other numbers here that they've changed, at the end of the day, our U.S. economics team is not changing our views on either inflation or the economy. They're still holding to their view. They're looking for 3 rate cuts this year, so that's certainly going to be an out of consensus call at this point in time, and then looking for ongoing rate cuts next year as well.
David, sort of zooming out coming into this meeting, I'm curious how you were thinking about the market and maybe where we've sort of unwound from a valuation perspective. Of course, I believe you were in this camp, many people in this camp, that the S&P 500 was overvalued. Valuations were stretched coming into the year. Well, you take a look at FactSet data for forward 12-month earnings, the S&P 500, we're really just sitting about average right now over the last 5 years. It hasn't unwound that much. Are valuations low enough now and re-rated to the right level where you're more interested in U.S. equities, or are we not quite at that point, this point, where it feels like it's a definite buy, valuations are too low?
Well, we're really pretty close. I mean, right now we do have, valuations at what I would consider to be at the bottom of the range that we still consider to be fairly valued. So again, overall, depending on your risk tolerances, I would look to have a market weight overall in U.S. equities. But I still think positioning is just as important now as it was at the beginning of the year. At the beginning of the year, we were recommending the overweight value stocks, underweight growth stocks. At the beginning of the year, growth stocks in general were trading at some of the highest valuations and greatest premiums over our valuations since we've seen really since early 2021, and that of course was the top of the disruptive tech bubble. So year to date, the Morningstar U.S. Market Index through yesterday's close was down a little over 4%, but it's really the growth index that was down the most. That was down over 8%, whereas value actually was up 3.4%. Having said all that, I do still see better value in value stocks going forward, specifically those value stocks with relatively high dividend yields. We have seen that sell-off in AI. In fact, I kind of really consider this a bear market right now in artificial intelligence stocks. Those stocks across the board are down 15 to 20%, some cases even more. Now they're getting to the point where a lot of those are 3-star, so puts in the range of fair value, but only starting to see a handful that have fallen enough that they're actually now looking attractive. A couple that we do like today would be Amazon. That's a 4-star rated stock at an 18% discount. ServiceNow, I think, looks pretty attractive. That one's down at least 30% from its high. It's a 4-star rated stock, trades at a 15% discount. And then for those investors looking for something that might be a little bit more speculative but have some more upside, I'd highlight Marvell. That's down 45% from its high. It's a 4-star rated stock at a 24% discount. But there's still some other AI stocks we think still have further to fall. ARM is going to be one of those more overvalued stocks under our coverage. It's a 1-star rated stock, trades at over a 60% premium to our fair value.
David, I'm curious, you mentioned bear market for AI stocks. There was one firm out there, Capital Economics, that had a note out today that essentially suggested if that bear market were to continue, then maybe the S&P 500 could enter a bear market even without a recession, just given how large the market caps are of a lot of those AI companies. I mean, is that a case that you could see playing out where we just keep selling mega cap tech to the point where the index gets weighed down too much?
Yeah, some of the mega cap tech is still a little pricey at this point, but if it were to fall and get back to our fair valuations, I don't think that would be enough to get us into a bear market overall for the S&P 500. So I'm not necessarily concerned about that. What I really think is that this is just a continuation of the theme that we highlighted early this year. So for 2025, I think this is the year that investing in AI really starts to evolve away from the hardware names, the GPUs, the networking names. In the old gold rush adage, people said it wasn't the miners that got rich, but it was the people that sold the picks and the shovels. That's last year's story. This year's story and going forward is going to be identifying those companies that can take AI, incorporate it into their own products and services, use that to help drive revenue, come up with new and novel use cases for it, as well as those companies that can take AI, put it in their own business processes, drive efficiency, be able to drive additional operating growth in their margins. Those are the companies that I think are going to be the next wave to look for that trade.
And David, I know that something you brought up in your notes, one of your colleagues writing that tariffs were not the real cause of the market sell-off, that it was more to do with this recalibration or repricing of the AI trade. But if that is the case, and we do start to get more deteriorating hard data, economic data, as a result of the tariffs actually being put in place rather than just anticipation of them, doesn't that imply there could be, in other words, if this wasn't the pricing in of the tariffs, do we still have to get to pricing in of the tariffs?
Well, and I think you have to be very careful, when you're talking about the potential impact, of the tariffs. And a lot of people, are still talking about the existing tariffs that are put in place right now, the across-the-board tariffs with Canada and Mexico. But, in my own opinion, when I think about what's going on with the ongoing negotiations, those in my mind aren't going to be the tariffs that are going to be in place, 6 months from now. So I think it's really trying to understand, what the longer-term perspective of the tariff negotiations are. I think President Trump Trump and his administration are probably trying to put together a new trading bloc with Canada and Mexico. Once we have that new trading bloc, probably bring in some South American and Central American countries as well. I suspect afterwards he probably targets the EU next to be able to renegotiate trade terms there. But then I think really the big and more interesting negotiations will be once we have these trading blocs put together, then going and renegotiating with China. So I think the tariff uncertainty, and again I hate that word uncertainty, but there I am using it. That really is going to be something we're just going to have to live with in the markets. Probably for at least the next couple quarters.
David, I think we're all getting sick of the word uncertainty, but it doesn't seem to be going anywhere for now. We're going to have to leave it there. We'll talk to you soon.
All right. Thank you.
All right, shifting gears, Tesla shares rebound as the EV maker moves one step closer to robotaxi ride-hailing in California. Yahoo Finance's Pras Subramanian joins us with more. Pras, what is the latest on the highly anticipated Tesla robotaxi?
You said it one step closer, right? This is this A certificate that they got from the CPUC, the California regulator. Basically, it allows them to test ride-hailing with employees. So they can't use the general public. They can't be in other designated areas. So it's kind of like a mini test, sort of what the first step is, and you want to sort of figure out if you have a robotaxi and ride-hailing product here. As we know, this is sort of the big sort of factor in the massive valuation of the company is can they unlock robotaxi testing, and then the big testing also potentially coming in Austin, Texas, which is the big trial because it seems to have a less regulatory environment down in Texas, so they may have to be able to push it further there than in California, which requires the DMV permits, CPUC permits, all kinds of stuff there.
Gotcha. So not there yet, but a little bit closer.
Yeah.
Meanwhile, there was an analyst that upgraded their rating today on Tesla. They happened to be at Cantor.
Yes.
Which also happens to be Commerce Secretary Howard Lutnick's firm, which I know Bloomberg took note of. But what was the context of that upgrade?
The context was the ride-hailing sort of future.
So that was the actual.
That was bullish. They visited, they did a factory visit, and they came away with some bullish sort of thoughts on ride-hailing, the future of that, Austin, Texas. Also FSD expanding in Europe and also China. But I mean, you just said it, Julie. It really is the most interesting part about it is the fact that Cantor, where Howard Lutnick works with Elon Musk at the White House now as Commerce Secretary, sees a big upgrade there from neutral to overweight.
Right.
Just sort of raises some eyebrows, but
yeah, I mean, it's not to suggest he's calling up the analyst. He's kind of busy at this moment, but still.
I will say that, and his name's Andre Shepard, noted that Musk's political activities could be a condition that sort of weakens Q1 results. So they're talking about it as a Q1 potential headwind. Who knows if it'll expand beyond that?
Right, if it will last. Thanks, Pras. Well, coming up, the ongoing economic uncertainty muddying the road to recovery for the housing market. We'll discuss the latest on the other side. Stick around, more market domination still to come. Gilead stocks closing lower today after the Wall Street Journal reported the Department of Health and Human Services was considering federal funding cuts to domestic HIV prevention. Joining us now, Yahoo Finance's Anjali Kamlani. So talk to us about the tie-in between that and Gilead and what this might mean.
Yeah, the reason why Gilead stock was impacted is because it is the provider of HIV prevention medication. And so this is sort of the area that would be affected by the budget cuts. Now, what's at stake is actually not the drug itself or any kind of purchase or reimbursement for the drug. And so that's why you saw a little bit of paring back of the loss there. Gilead has the sales of this HIV drug, PrEP, pre-exposure prophylaxis. It's not a treatment. It's sort of a vaccine, if you would say, but it's not a vaccine. Don't mix the two. It relies on sales mostly in the commercial market and does have a little bit of Medicaid patients. And so that's where potentially there could be some impact. But I've seen a bunch of analyst notes saying, including JP Morgan, saying modest, if no impact at all, noting that the cuts to the budget is mostly about surveillance of HIV prevalence, as well as community efforts to kind of get syringes out there and the like. So nothing to do with the drug. So this is a bit of an overreaction.
Gotcha. And PrEP basically is if someone is infected with HIV or thinks they've been infected, it helps suppress symptoms.
Correct. And you can take it before any activity that would put you at risk of getting a
Gotcha.
So
Okay.
That's right. And this is just another example of sort of like something that's happening in potential discussions at the federal level that could hit a stock, but doesn't really. We just saw recently that the NIH was talking about, scrubbing the references to mRNA out of any kind of potential grants and research work. So no impact to Moderna there, but still, just things happening in DC as they are right now, potentially impacting the future of some of the research and some of these company products.
I mean, Jay Powell said it today, uncertainty in many
The word of the day.
areas. Thank you, Anj. Appreciate it. Well, the Federal Reserve holding interest rates as the central bank takes a wait-and-see approach to the effect that tariffs could have on inflation. Policymakers staying cautious amid that uncertainty, there's that word again, of President Trump's economic policies, and that ongoing uncertainty muddying the road to recovery for the housing market. Here to discuss, Lee Everett, Executive Vice President and Head of Research and Strategy at Cortland, which is an owner of multifamily, or AKA apartment buildings, right?
Yeah.
Lee, thank you for being here.
Thank you for having me.
So with rates staying stable here, we have seen mortgage rates come down a little bit, but there hasn't been much relief on that front. So what are you watching?
We're watching sort of twofold. I think the uncertainty word is particularly relevant to housing as well. It's a lack of policy clarity has sort of created a divergence of factors, if you will. Mortgage rates have come down some, debt spreads have come down some as people have been more eager to lend and get back to work. But at the same time, you have both inflationary pressures that are of concern, and you saw at the same time the Fed lowering their growth outlook. So that creates sort of a question of where's demand going to be? Where are rates going to be? If we do enter a recession, do rates reset on the other side? What happens to the housing prices in the interim? Likely they decline. And where does demand go in the interim? So you sort of have two fields you could follow. Now you have the higher for longer, soft landing, higher rates, market continues sort of as is. That said, even as is, you're seeing existing listings lasting longer. You're seeing new home sales starting to slow. You're seeing a buildup of inventory there, and you're seeing more builder incentives. The other is sort of that recessionary scenario I mentioned earlier, where pain in the short term, lower rates, hope for a rebound on the other side.
So is there a scenario there where the recession economic scenario is actually better than the stagflation, sticky inflation, slow economic growth scenario as far as housing market goes?
I think stagflation is the most dangerous term in housing you can look at. If things are expensive and you have less demand for housing, things get much more problematic. And where the recession will provide particular relief is especially in the multifamily sector, where you had some people buy in the zero interest rate environment at floating rate debts that haven't been able to manage said debt. Now, this is not typically your institutional players, it's more your syndicators that can't afford interest rate caps and such, but that would bail them out. It would give short-term demand shockwaves, but at the end of the day, the second half of this decade, we're likely to have a continuingly tight labor force, continuingly higher entry-level salaries as the baby boomers have exited the labor force, and that's created an immense need for younger labor. If in the short term there's a disruption, that's one thing. In the long term, you are likely to return there. So lower rates, a return of demand, you could have a better outcome. Stagflation is the absolute worst case scenario.
And I'm curious, as you look at this decade, what your outlook is for home ownership, especially as it relates to the rental market. Are we going to continue to see that decrease in home ownership, the home ownership rate amongst Americans?
I think there's a bit of a misnomer right now that people can't buy homes. The homeownership rate's right around 66%. It's only really been higher than that leading up to the Great Recession. What my theory is today is it's more of a mismatch of product. Those baby boomers that I mentioned earlier, they have the majority of the 3+ bedroom product in this country today. They are living longer, have immense wealth to hold their product, and don't need to sell to retire at this point in time. So you have a lockup there. The millennials entered the housing market en force coming out of COVID, corrected back to historical averages. They have the more family-oriented starter homes and the smaller homes such as that. And then Gen Z is kind of stuck. But I think what's more likely to happen as relief is the ability for those baby boomers to downsize, to not take on a 7% mortgage, and you get move-ups from the other people. I don't foresee us being a country with a homeownership rate ever much higher than 66%.
But maybe not much lower either. I mean, what you're describing, though, in terms of the baby boomers, you have to wonder at what point, if the stock sell-off continues, will you see more, not forced selling, but will you see more of those baby boomers getting out of that big asset to raise cash if the market continues to deteriorate?
There's two particular questions I have with the sell-off. A, do the baby boomers exit for cash, as you highlighted? And B, they've been carrying a lot of our consumption at this point in time. They're big spenders and they aren't economically producing. So that's a lot of this fueling this need for labor. If they stop spending, does that cascade down the line to layoffs in some of the service sectors and some of the airline sectors and things such as that? So I do think this is very much driven by how the baby boomers proceed over the course of the next 6 to 12 months.
And I'm curious, Lee, when you think about you were sort of alluding to that inventory issue, right? The people that want a 3-family house or 3-bedroom house right now, it just doesn't exist in a lot of parts of the country. How does that get solved? It feels like it just isn't going anywhere, and we've been talking about it for years now at this point.
I think there's sort of, again, a different approach to both. I think you do need the baby boomers to start to give up sort of their grip on housing. NIMBYism generally prevents people from building housing in those inner ring, high quality submarkets. Unless you can get through to those local governments and local people, you're going to struggle there. Secondly, you have seen a shift in preferences for younger people that value location, a lack of maintenance, and things along those lines. We just did an independent third-party renter survey, and 32% of people responding to that survey said they actually foresee housing as sort of the American dream at this point. So you see less and less young people declaring the need to own a home and more so valuing, I'll live in an apartment building that's well located, enjoy the urban amenities, enjoy the flexibility, and find other ways to raise equity over the course of my life. And again, that's been fueled by the various other indices and digital and crypto and whatnot.
Really interesting. Lee, thanks for coming in. Appreciate it.
Thank you.
Time now for What to Watch Thursday, March 20th. Starting off on the earnings front, some big names reporting tomorrow, including Accenture, Nike, and FedEx. Nike will announce results for the third quarter after the close, and analysts expect a weaker quarter for the company as it faces pressure from markdowns to clear out unwanted inventory. This also, by the way, marks the first full quarter at the company for recently appointed Nike CEO Elliott Hill.
Moving over to housing, a key piece of housing data coming out in the morning with existing home sales. Economists forecasting February sales to decline to 3.95 million on a month-over-month basis. The new number rounding out a busy week of housing data alongside the Fed's decision to hold interest rates steady in March.
And finally, a big moment in the video game industry and a pivotal one for developer Ubisoft, the company releasing Assassin's Creed Shadows tomorrow, the newest chapter of its flagship franchise. Ubisoft's had a rough year with the much anticipated release of Star Wars Outlaws underperforming, so it's a make or break moment for the video game developer, competing with rival Take-Two's release of Grand Theft Auto 6 later this year. Very hotly anticipated release for producer Dan Nelson, who writes What to Watch.
I can't wait.
Is that true? Really?
No.
Are you a
But
gamer?
No,
I don't know.
We'll get into it.
Sure.
We got to get into it for Dan.
We do. That'll do it for today's Market Domination Overtime. Thanks so much, Josh Schafer, for hanging out with me today. On the other side of the break, it's Asking for a Trend. I got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.